Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 288 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about how to save for retirement without a 401k. Because 401ks, they are very well known, they are very useful in saving for retirement, and they are offered in a widespread way. And I want you to know, even if you do not have a 401k, you still have just as good a chance as any to save up, to become wealthy, to become a millionaire, and to have money to retire on. That is absolutely plenty. So you don't have to have a 401k, and I'm going to show you how in today's episode. So stick around for all that and more in today's episode. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now look, I know I talk about them all the time. I talk about 401ks all the time. Okay, I talk about how powerful a 401k is. I talk about how useful 401ks are. I talk about all the situations in which you can use your 401k for X, Y, and Z. Okay, but I really want to focus on individuals who don't have one, right, or don't have access to them. Because for those of you who don't know, a 401k is a retirement plan type that is offered by your employer. Okay, so if you don't have an employer that offers one, or you're self-employed, then you do not have access to a 401k, right? It is 100% reliant on what your employer offers. Okay, so if you don't have one offered to you, then you just don't have one. Okay, but that does not mean that you are, behind the eight ball when it comes to your retirement savings. It does not mean that there's any extra pressure on you. It doesn't mean that there's anything that you're going to have to do that's just crazy different from other people, right? But you are going to have to find other places to save and invest money for your retirement future. That's undoubtable, right? We still have to save and invest for retirement, even though we don't have a 401k. Okay, so I want to speak directly to those individuals because a lot of individuals don't have 401ks, 403bs, TSP, other types of employer-sponsored retirement accounts offered to them. And so I want to make sure that even you can know that your investing isn't going to look like other people's investing, but it can be just as effective. And you're going to be able to use a lot of the same mechanisms, a lot of the same account types, things like that, that individuals who would have a 401k would use or consider in their own investing life, which is a very big advantage that you have. And not to mention, you're not tied to an employer here, right? So you're going to be able to make a lot of decisions for yourself. So whether or not that's a good or bad thing, we'll talk about that as we move forward. But let's talk first. Right? What are the advantages of having a 401k in the first place? Right? Why is a 401k or 403b or TSP or any other employer-sponsored retirement account so valuable to us as retirement savers? Okay. Well, the first thing that I can think of is that it's tax advantaged. Now, I know there are other types of accounts that are also tax advantaged, but one key to the 401k is that it is a tax advantaged account, meaning that if it's a traditional 401k, the money goes in before taxes. The money comes out of your check, goes in before taxes. You get a tax deduction on that money. That money grows tax deferred over time, and then you pay taxes on it later on, right? So you get to defer taxes and get a tax deduction on the front end. Then the 401k also has very, very high contribution limits relative to other types of retirement saving vehicles. Okay, the 401k currently is allowing $19,500 per individual per year to be put into the 401k to max it out. And that's very, very high contribution limit. If you're able to invest nearly $20,000 a year, that's awesome, right? You're going to end up with some major wealth by putting that amount of money away. Okay, but the 401k allows you to do this. It allows you to have this much money to put away. Okay, the 401k also is going to have the paycheck deductions. Okay, so before you even see money come into your bank account, right? You get a direct deposit every 2 weeks, every month, whatever. Before you even see that come into your account, the money for your 401k is already gone, right? The money that you're allocating towards your 401k is already taken out of your check before you ever see your check. Now, what this does is this takes away a lot of the frictions. Okay, this takes away a lot of the frictions to investing because it's just done automatically. You don't have to do anything about it, right? The money is easily put away. It's absolutely no problem. Okay, so it takes away a lot of the frictions of investing in that particular way. Then the 401k match is probably the biggest advantage to the 401k. And the way that this is an advantage is you're going to get free money. Okay, so if your employer offers a 401k with a match, right, there's a reason this is the third part of the financial action plan, because this is getting free money. It's getting a 100% rate of return up front. Okay, you put in a certain amount of money, your employer immediately puts in a certain amount of money on top of it, and you just can't beat that in just about any other type of retirement account that you go to, because there's nobody else there that's going to be matching the amount of money that you're putting in. Okay, so that's extremely advantageous as well. The 401k is also going to allow Roth options, meaning after-tax options, for all individuals, regardless of income. So, when it comes to like a Roth IRA, there are income limits to contributions to a Roth IRA, but that is just not the case with the Roth 401k. The Roth 401k has no limit to the amount of money that you can make in order to put money into it. And for those of you who don't know, Roth is the other type of tax advantage, and it's basically just you put in after-tax money, right? Money that's already been taxed. It grows tax-free, and then you take the money out later on with no taxes. Okay, so that's extremely advantageous as well. And then the last advantage that I'm going to talk about here, and there are other advantages quite obviously, okay, but the last advantage I'm going to talk about here is the fact that in a 401k, 403b, other types of employer-sponsored retirement accounts, you can get to your money earlier than you can with other types of retirement accounts. Okay, so typically with the 401k, you can get to your money at age 55. So if you wanted to retire at 55 and start taking withdrawals from your 401k, then you absolutely can do that. Okay, but with something like an IRA, Roth IRA, you're not going to be able to take that money out until 59 and a half. Okay, so there are just some distinct differences between the 401k and other types of retirement saving plans, and I want you to be aware of them before you just step into this place where you are trying to invest, maybe even with your eyes closed. Now then, let's say that the 401k is not available to you. What should you be focusing on from there? Where should your eyes go as far as your retirement savings options? Okay. What we want to make sure of first and foremost is that we can find other ways to get tax advantages, because like I said, one of the main advantages of the 401k is the tax advantages that it offers. Okay, so what we want to look for is types of accounts that have either the pre-tax advantage, where you get a tax deduction on the front end, your money goes tax deferred, and you pay taxes only later when you take it out, or you want tax-free growth and tax-free distributions later on, but putting money in with after-tax money at this point. Okay, so the first places we're going to look, and the first place that I think you should, just eye your focus if you do not have an employer-sponsored retirement account, is an IRA, and specifically a Roth IRA. So an IRA is just an individual retirement arrangement via the IRS, but many call it the individual retirement account. Okay, and what the IRA allows you to do is it allows you to basically invest in what you want to invest in. It has more flexibility than does the 401k. Okay, the 401k is typically going to allow you to invest in some preset mutual funds that it has, or preset account types that you can choose from, that your employer has decided that those are suitable for this type of account, or whoever they have advising the 401k says it's suitable for this type of account. Okay, but with the IRA, you can literally invest in anything. Individual shares of stock. There are even ways to invest in like gold in IRAs. You can invest in bonds and IRA, individual bonds and IRAs, and then any number of things that may be offered by whomever is supplying the IRA for you, whatever brokerage house you are using. Okay, now here's the IRA. The IRA, specifically the Roth IRA, we'll start there. Okay, the Roth IRA, you can put up to $6,000 per person per year right now, and then if you're age 50 or older, you can put up to $7,000 per year per person. Okay, again, you can choose from thousands of mutual funds, and it really makes it easy to spread out your investments into the several categories that you may want to spread it out into. Now, when you put money into a Roth IRA, it is after-tax money. Now, here we're not talking about a direct pull from your check. Okay, this is not offered by your employer. This is something you're going to have to go out and sign up for by yourself with some brokerage house, Vanguard, Fidelity, Charles Schwab, any number of them. Okay, you would have to go sign up for this, and so you can set it up as a direct deposit from your bank account. Okay, but this is not, coming directly from your check. So you're going to have to take the initiative here. All right, so you would contribute after-tax money, so money that's already been taxed, and that's very simple if you're just, doing it out of your bank account because the money in your bank account's already been taxed. Okay, so after-tax money would go in. All right, the money would grow in whatever you decided to invest it in, tax-free, and then later on you could take the money out with no taxes. Okay, and you could take the money out at 59.5 with no taxes. Now, the only eligibility requirements to funding a Roth IRA is that you have to have earned income. Okay, so you have to have made money, right? And then you have to have what's called a modified adjusted gross income, right, which comes from your taxes, that is $198,000 or less for married couples filing jointly, or $125,000 for single people. Okay, now, for married people, this is very, very important and very, very, big. If you are not able to get your hands on a 401k with such high contribution limits, with Roth IRAs or just IRAs in general, for the married couples, each individual can have a Roth IRA. And whether or not you make money or your spouse makes money, right? Let's say that one spouse stays home with the kids and the other spouse works. Okay, well, if you file a joint tax return, you can open IRAs for both of you and max both of those IRAs out. Then you can put up to $12,000 total into the IRAs, and then $14,000 total if you are over the age of 50. Okay, so this really opens up the ability to invest more. But the reason that we start with the Roth IRA is because that after-tax money is so powerful. Tax-free growth is so powerful over a long period of time, right? But you can also put money into a traditional IRA, right? Which means, again, that you put in pre-tax money. Now, this can be money that is technically out of your bank account after tax, right? Again, this is not coming directly from your paycheck. So all of the money that you would be putting in is after tax money, okay? But it is treated by the IRS as pre-tax money, meaning that you are going to get a tax deduction on your tax return for this specific amount of money that you put in. And again, you can put up to $6,000 a year and $7,000 if you're 50 or older, okay? Now, unlike a Roth IRA, there are no annual income limits, but you're required to begin withdrawing once you turn age 72, which is called required minimum distributions, right? There are specific amounts that you'll have to take out, okay? But you have to pay taxes on all of the money that you take out at your income tax rate. Also, with the traditional IRA, you need to understand that there are limits for the deduction, okay? If you make too much money to get the tax deduction on the traditional IRA, then you can lose one of the advantages to the traditional IRA. But that traditional IRA is going to fall second in line behind the Roth IRA in the order of being able to do this. Now, you can also, if you don't have income that's within the income limits for the Roth IRA, meaning you make too much money, you can put money into a traditional IRA and then convert it to a Roth IRA, meaning basically you just pay the taxes on the money that you put in. And if you put in after-tax money already into a traditional IRA, then there is no payment of taxes. You just transfer it from one account to the other. But I would suggest you using a CPA before you go about making this type of transaction, because it can be quite tricky, and you want to make sure that you don't end up owing taxes where you shouldn't have to owe taxes, and you get the Roth conversion down correctly. They call this the backdoor Roth strategy, okay? So the Roth IRA, the traditional IRA, they are perfectly good ways that you can save for retirement. And even if you do have a 401k, the Roth IRA or traditional IRA may be better choices for you, okay? And I'll explain how. If you don't have a Roth 401k, right, then putting money into a Roth IRA would be your next step after you took whatever match you had offered to you in the 401k. And if you didn't even have a match offered and there was no Roth option, then you would go straight to the Roth IRA. And I would even say that if there's no match offered, I would go directly to the Roth IRA first, right? Because, hey, I can go ahead and put money into the Roth IRA and have freedom in what I'm investing in, right? There's no limitations as to what I'm investing in the Roth IRA, and then go back to the Roth 401k without a match and continue there. The advantage to the 401k is the high contribution limits, obviously, right? So it's a place where after you've put money into your traditional IRA, Roth IRA, whatever, you can circle back. But the advantage also comes with the match, right? The match that you have there, it supersedes everything. If you have a match, right, then you would put money up to the match before you ever went to the Roth IRA or traditional IRA, okay? But I would go 401k with a match, Roth IRA, traditional IRA, 401k without a match. Now, if you have a 401k without a match that has a Roth offering, I would move that up above the traditional IRA just because you have access to more Roth assets and it's more valuable to you, even if you just have to put it in some type of index fund within your 401k. Okay, so that's what I would do. That's how I look at investing in other retirement vehicles. But again, we're talking about for people who don't have 401ks. But even if you do, you may use the Roth IRA or the traditional IRA as well. Now, let's say that you're self-employed, and a lot of individuals who are having to deal with this are self-employed, right? They're like, okay, well, I work for myself and I don't offer myself a 401k. What can I do? Okay, so if you're self-employed and don't have any employees, a one participant 401k, this is known as a solo 401k, may be right up your alley. Contributions are tax deductible, meaning that it's put in pre-tax money. You get a tax deduction, and you can contribute up to $19,500 a year, or $26,000 if you're age 50 or older, which is the same as the contribution limits for the 401k. Then on top of that, you can put in up to 25% of your income as long as what you contribute is less than $58,000 a year. So if you are self-employed, and let's say you do make a lot of money in being self-employed, right, then you could end up putting up to $58,000 a year into this solo 401k. So this is very valuable in the way of having high contribution limits, even if you have high income. Okay, so the solo 401k may be an option. Then another option is the SEP IRA. SEP IRAs are primarily used by small business owners who want to help their employees with retirement, but freelancers and the self-employed can also use this option. You can contribute to your own retirement this way, but again, you can't exceed either 25% of your income or $58,000, whichever one is less, okay? And SEP IRAs is just SEP, and this just stands for Simplified Employee Pension. Okay, so you can set up retirement accounts for yourself and your employees. Now, if you do run a small business with employees, okay, the rules of the road, they do change a bit. Okay, a great choice is the Simple IRA, which requires you to offer up to a 3% match for your employees every year, and contributions are tax deductible. Simple IRAs come with an individual limit of $13,500 a year. So simple IRAs are a great option if you do have employees and you want to provide them with something as well as yourself, right? As well as yourself being an employee of whatever business. Now, obviously, if you don't have a 401k specifically, you could have other types of retirement accounts that are employer sponsored. Okay, so if you work for a nonprofit or other tax exempt organization, a 403b is another great pre-tax investment option that works like a 401k. And some 403bs, they also have Roth options as well. Okay, they're very, very similar to the 401k. And then federal employees can save for retirement through a thrift savings plan, or a TSP. And TSPs usually come with matching contributions and allow you to make after-tax contributions with the added plus of tax-free withdrawals when you retire, right? So they have a Roth option. And you can also choose how to split your TSP contribution among several investment options. Okay, so those would be options if you don't have specifically a 401k, but you do have access to these other employer-sponsored retirement accounts. All right, then what else can you do? Where else can you put money to invest for your future? Those were some ways that I think are very straightforward, but there are two more that I want to hit on. One, you can invest money in an HSA. So if you have a high deductible healthcare plan, right, you can set up an HSA, a health savings account, where you put money in. It's triple tax advantage. That's what I've told you before. You put money in, you get a deduction for the amount of money that you put in, right? You let the money grow in a tax-free manner, and then you can take the money out later for qualified medical expenses tax-free as well. Now, what's the kicker to the HSA? Well, the kicker to the HSA is that if you do not use it, you do not lose it. Okay, so the HSA is always yours until you use it up. And if you hit age 65 with money still in your HSA, you can take that money out for non-qualified medical expenses. So it doesn't have to be medical expenses at all, right? You can take it out for whatever, okay? But then it is treated like a traditional IRA. So you can almost have another traditional IRA on your hands if you do have a high deductible healthcare plan that is HSA qualified, okay? So that would be a potential way that you could invest your money and have money in retirement for yourself that would be treated much like a traditional IRA if you were to choose to do that. And then ultimately, what everybody has the ability to do if they don't have a 401k or they're not able to put money in other places, right? Above all else, you can just put money into a taxable investment account, a taxable brokerage account, right? And with the taxable brokerage account, it's really, really straightforward what happens. Okay, you purchase whatever mutual funds, ETFs, stocks, bonds, whatever, right? As you go along in having this particular type of account, taxes are going to be due, and taxes are going to be due on the gains that get realized. So what that means is if I buy, let's say, a share of stock, right? And that share of stock doesn't pay me any dividends and it just grows over the course of a year. And let's say I don't sell it and I just continue to hold it. I'm not going to owe any taxes on that because I have not realized any gains, even though it may have some gains. But if I buy a share of stock and then a year later I sell it, or let's say a year and a half later, I sell it, then on that next year's taxes, I'm going to have to pay long-term capital gains rate on the gains of whatever I'd invested in there. Okay, just the gains, not on the total investment, but just the gains. Okay, and then if it's within a year, right, if you buy it and then sell it 6 months later, on that year's tax return, you are going to have to say, okay, I had this much in short-term capital gains, which is taxed at your income tax rate, right, which is a higher rate than the long-term capital gains rate, okay, and you will have to pay taxes, again, just on the gains, not on the entire amount that you had invested in this particular, whatever it may be. Okay, but you can use a taxable investment account. The advantages here are the fact that you can put as much money in as you want. You can take the money out whenever you want. There are no limitations as to your income or anything else. There are no limitations. It's literally a savings account in which you can invest money and you can open one just about wherever. Okay, if you have a Robinhood account, I'm going to guess it's a taxable investment account. All right. And this is a way that you can, again, do a lot of saving for retirement. And this can be specifically used for what we call bridge investing. Meaning if you want to retire early, if you want to retire, let's say at 45 or 50 or whatever, right? You can put money into taxable investment accounts to where you can get your hands on those monies without any type of penalty before anybody else can get their hands on their money in these retirement accounts that we've talked about previously. Because all these other accounts, they do have limitations. They have limitations as to when you can get your hands on your money that are very similar to the 401k and the IRA. Okay, so you need to be very well aware of that, right? But you need to be aware of these options. You need to be aware that even if you don't have a 401k, or let's say you don't have a 403b or TSP or whatever else, right? Even if you don't have those options, right, that you do still have options, right? But you have to take it into your own hands, okay? Now, it's quite obvious that hey, taking things into your own hand creates a little more friction. It creates a little more in the way of, oh, crud, I have to do this. I can't just rely on my employer to supply something for me and then I can just sign a piece of paper and say I'm in, right? No, I have to decide that I'm in, and I have to see money leave my bank account every single month to go into whatever it is. And I have to make the changes in my investments if I want to, right? It's a little less simple than just putting money into a 401k. And it's definitely not as easy. It's not as easy as just saying, yep, give me the 401k and I'll just put money into an S&P 500 or whatever else and just continue on, okay? It's not that easy. You have to make some conscious decisions. You have to be very intentional with your money sometimes. And this is a place where if you don't have the option of an employer-sponsored retirement account, you must be very, very intentional with how you invest. You need to make sure that you are getting the tax advantages that are offered to you, like in Roth or traditional type of accounts, right? Or, you put money in HSA, whatever else, okay? But nonetheless, whether or not you're putting money into tax advantage retirement accounts like those, or you're just putting money into a taxable brokerage account, what I want you to know is that you have to just put money in somewhere. Okay, you need to be putting money away for your future. Yes, we want to be as tax efficient as possible. Yes, we want to be putting as much money away that is not going to be taxed for as long as possible, and the gains aren't going to be taxed and whatever. We want as little bit of taxes to be paid in the future as possible. Okay, in a very, very legal way. We want as little paid as possible. Okay, but ultimately, if you just put money into a taxable brokerage account and you just let it grow over a long period of time, even though it's taxable, you're still going to have money, right? And you're still going to have money to, live your retirement dreams, live your dreams over the long term. And that's all I really want for you, okay? I'm not so worried about the little minutia. Yes, I hope you understand what these different types of accounts are. And I've done several episodes that talk about Roth IRAs, traditional IRAs, all these different things, right? So I hope you understand those. I hope those make sense to you, okay? And if they don't, then you can go back and look and you can do your own research and find out a little more, okay? But what I hope more than anything is that just because you don't have a 401k doesn't keep you from investing. Okay, I still want you to be active. I want you to be very, very well-versed. I want you to understand what's going on in your investing life, and I want you to be intentional with actually putting money into some of these places that will allow your money to grow over a long period of time. And keep the same ideology as you would even if you had a 401k, 403b, TSP, whatever else. Now, I know it's a big disadvantage to not have a match offered to you. I understand that, right? I understand that it's a big disadvantage to not have that 401k match because free money is free money, and that is super valuable. Now, if you had a simple IRA, you could get a match of maybe 3% or whatever, right? But nonetheless, that 401k match, it just comes so in handy for so many retirement savers. But I don't want you to think that just because you don't have it offered to you that you can't do it. You can absolutely do it. And most individuals, they invest in their 401k without even thinking about a match. And a lot of them invest in their 401k without even having a match. And they become successful in their investing over long periods of time. Why? Because they put money away, because they decided that, hey, regardless of what the little, provisions are, the little benefits are of whatever account I'm putting money into, I'm just going to put money in. And I'm going to put money in and put money in into reliable investments over a long period of time, and I will end up on top. And I think that's what you need to make sure that you're speaking into your own investing life on a week-by-week basis, month-by-month basis, in order to continue motivating yourself to continue investing over a long period of time. So, if you don't have a 401k, you absolutely have options. And if you say that you don't, then you just don't know, right? And hopefully today has helped you. Hopefully today has helped you to understand that those options are very real. Those options are very useful, and many of those options overlap with the options that would be available to individuals who do have 401ks. And in some cases, I would invest in some of these options that I talked about here before I ever touched a 401k, especially if that 401k did not offer some type of match. Okay, so don't think that you're disadvantaged or that you're just unlucky or that somebody else is privileged to have a 401k and you don't. No, just go out there and take advantage of the types of accounts that you have available to you. Okay, and you can be successful over the long term. Just make sure that you're putting money away and putting money away in a very, very aggressive manner. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who watches or listens to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.